Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Joe Downs. He's over 17 years of experience in commercial real estate and is a co-founder of the Belrose Group, which focuses on niche opportunities in the self-storage sector. He's led his firm's growth from acquisitions into development and consulting. And as a lifelong entrepreneur, he has been involved in securities, mortgage, hospitality, and real estate ventures. So thank you so much for coming on the show today, Joe.
Charles, so good to be here. Excited. Looking forward to questions you have for me today. One thing I just realized is I got to update that profile. It's been a couple of years because I think it's been 20 years.
Okay. So that brings us right into our first question. So tell us a little bit about yourself, both personally and professionally, prior to getting involved with real estate and ultimately self-storage properties over the 20 years.
Yeah, well, it was a journey. I'm where I didn't think I would ever be because I never imagined knew anything about self-storage, even 7 years ago. So it's pretty fascinating to me. You just never know, right? When one door closes, another one opens. You just never know. You just got to be prepared in life and ready to go. So about myself, I learned at I recognize is a better way to say it, at a late stage in life that I'm like a serial entrepreneur. Grew up in a big family, one of 12 kids, was always hustling and bustling as a kid because you had to, not to feed myself, that type of thing, even though, you get all the jokes when you're from a big family. But no, just because, there wasn't a lot of discretionary dollars. So if you wanted to do things, you had to work. So as a kid, I was always out shoveling driveways, selling kindling for firewood, caddying. I DJ'd, I bartended, as I got older. And then after college, I'll skip over one quick pit stop, but for 6 or 7 years, I was a financial advisor and but always bartended. So I always had like 2 or 3 jobs. And the writing was on the wall. I don't know why I didn't realize it. But and I was too busy working to reflect on anything, I guess. But so I, long story short, on being a financial advisor, 9/11 happened. No stolen valor there for me. I didn't lose family in the towers or anything like that. I just I wasn't happy in it being in the industry as it was, and that was just kind of the final straw for me. It was just like, no matter what you're trained to do and to tell people about it, just you really have no control at the end of the day, right? We're just small fish, and I didn't like that. I didn't like not having control. I didn't like talking to clients saying it's going to be okay when I have no idea if it's going to be okay. I don't know what tomorrow brings. Let's be honest here, right? So I had always wanted to be in real estate, but interestingly enough, something happened that week, 9/11. The markets were closed. So I had a friend, we were young, we were late 20s, but we did belong to a golf club, single guys. And we played a lot of golf that week because there was nothing to do. And one day we were reflecting on what our futures were going to bring us because neither one of us wanted to stay where we were. And we both wanted to get into real estate and realized that the two wealthiest people we knew, and I don't mean Warren Buffett or Elon Musk or anything like that, I mean that we actually knew, were in real estate. And so for me, it was, all right, the journey begins now. How do I get into real estate? Well, it didn't, it wasn't a straight line. It wasn't a straight path. I bartended, opportunity came along to own the bar and restaurant that I bartended at. It got shut down. Long story short, it was a Villanova college bar that got shut down. So the owners approached me about taking it over. We had to redo it, bring it back as a bar and restaurant versus just a bar. It lasted about a year. I knew the front end of the house. I knew how to run that from just, years behind the bar. I didn't know anything about running a kitchen. That's where all the expenses were. That was the sinking ship. I trusted a chef to do it. I call it, it's one of my learning examples in life. It's easy to look back on and say, wow, what a great experience and learning experience. It was brutally, brutally awful at the time I went through it. Lost a lot of money, lost my job, right? Lost pride, lost credibility with some people. Not credibility, but a little bit, I guess. My reputation took a little bit of a hit, I would say. And that was tough. So I had to reinvent. And I ended up taking a job selling talk radio. I knew it was always a stopgap, but I was broke. I just lost everything I had, and I owed about 80 grand because I borrowed money from friends and family to get into the venture. So life was not looking up at that moment, but I took the job, started selling radio, and this is what I meant earlier when you never know when one door closes, what door is going to open if you just keep moving forward. Forget the line from Rocky, which I should know exactly because I'm from Philadelphia and I'm sitting here in the suburbs of it, but it's something to the effect of winning isn't about how getting knocked down. It's about getting back up, right? And not about how hard you get knocked down, but about getting back up, right? So you'll see in my journey, there's a series of knockdowns and getting back up and trying to figure it out again. And this was just kind of another one of them. And so I was selling radio, and along comes one of my clients who is a real estate education company. And they want to advertise on the radio. It was talk radio. It was conservative talk radio in Philadelphia. And they wanted to advertise to put butts in seats at hotels because we were doing seminars then, not webinars, because there was no technology. We had no Zooms. We had no, anything like that. There were no podcasts even for me to listen to try to figure out what the next step was. So I commend you for bringing, hopefully I end up interesting to your audience, but for bringing probably way more interesting people to your audience. Like, I commend you for that because we didn't have that back in the day, right? This is circa 2004, 2002, 3, 4, 5, 6 is kind of the next period I'm talking about here. And so I'm working with this client, and they're having success, and they're putting people in seats, and they're teaching people how to buy, rehab, and either flip or rent single family homes. And they were Philadelphia based. So after, maybe 6 months of working with them, and me always wanting to get into real estate and having this mental block, that's another reason these podcasts are so great. I had this mental block at the time that, and I was reading some books, but even then, the podcasts tell you what books to read. I don't know what books to read. I was, you're searching for stuff on your own or word of mouth. So, but I had this block, and I laugh about it now, that there's no path for me to get into real estate. There's no real path, which was just so dumb because there was obviously so many ways to get into real estate. And I needed the encouragement or the podcast to listen to or the right book to read or the right person to show me the way. So along comes this company, and I'm like, what am I doing? This right here in front of me. So I took their course. I started doing this. Now I had a third job because I was still bartending at another job. So I'm selling radio a day. I'm bartending 2 nights a week. And now on Saturday and Sunday mornings, where I could have been driving around listening to podcasts like you, I wasn't. I was probably listening to the radio, and I was looking. I got up early every Saturday, Sunday morning, and I would go out and look for, at least my goal was 10 houses. I wanted to see 10 houses. So I'd map that out the week before and go see 10 houses. Keep in mind, I'm broke. I have no money, so I can't buy anything. I want to wholesale. So I started wholesaling. And so I did that, and what was I making? $5,000 a wholesale. And actually I had a partner in a lot of them, so I split it. So I was making $2,500 a wholesale, and because I think I needed the partner for money because I didn't have any money. So we were splitting the wholesale fees, but it was that was a decent amount of money at the time for me. Trying to recover, especially with all the debt I had, and I was learning residential real estate in the business, and that was great. And then another client came along, and because I couldn't quit my job, but just doing that at that point, at least I thought that was maybe another mental block. But another client came along. They were a developer, and they were advertising these high-end condos in just outside of the city, which was, from a tax abatement standpoint, made sense. And I became friendly with the broker, the real estate broker, who they built a demo unit across the street from my office, and became familiar and friendly with the broker. And he told me about his friend who needed a sales guy who had a background in securities, needed a real estate sales guy who had a background in securities. What do you know? I have a background in securities. I still have my Series 7. It was inactive, but I had it. So I met with him, and then I took that job. So now I didn't know anything about commercial real estate. I had to learn about commercial real estate, but that was the easy part. What he needed was someone who could sell and understood the securities angle. So I started to just lean in and immerse myself and learn about commercial real estate. We were buying and selling interest in, and this, by the way, why securities? We were doing, it was all 1031 exchanges, but done as securities. All right. So they were private private offering, syndications, 506C offerings back then. And so we were buying and raising money for multifamily and office at that company. And I learned, it was an incredible experience, learned a tremendous amount. I ended up raising over $90 million over a couple of years for these exchanges. These were the kind of bigger deals, $25 to $30 million deals. And it was an incredible experience until the markets crashed, and the debt markets crashed first in 2007. And then we all know the story about 8, 9, and 10. What's funny is when I was a young, strapping, young buck financial advisor, you heard about this crash and that crash and what happened. Now I've lived through them, which just means I'm old. But it's different when you can actually reference them historically as something you've experienced. We're out of business is the bottom line. Within 9 months, those companies were all out of business because we were doing 1031 exchanges. And if interest rates went through the roof, no one was doing anything in commercial real estate. Banks weren't lending. Banks aren't lending on real estate. There's no buyer. If there's no buyer, no seller, no exchanger. So guess what Joe's doing again? He's reinventing again. What are we doing now? That with my new tool set, right? I got new arrows in the quiver, and now I got a new war to go find, a new battle to go fight. Or first I got to find it. So, and I, for maybe another 9 months, because I was in that world, I ended up being hired as a hired gun, raising money for distressed debt fund, oil and gas deal, a platinum LEED certified office building, but never storage. Never once in my travels did I ever see a storage operator, owner, building. I didn't even know what storage was, if I'm totally honest with you. I never rented it. I guess if you'd asked me back then, I would have said, I don't know, it's those garage-looking things with orange doors. Right? To me, that was storage. But I didn't know anything about it. Never met anybody in it. So, but I'm not there yet. I go to a tax lien seminar in Philadelphia. I was invited by a guy, so I'm thinking, am I going to get into the tax lien business maybe? And something in real estate. I want to stay in real estate, and I didn't see the pathway there for anything really substantive. It seemed like a nice hobby, but not a business. And ended up meeting a partner who ended up becoming a partner. Met a guy there who we started talking. We lived near each other. Started talking about different types of deals and trying to do different deals and raise money for this and do that, and largely failing. And he says, I bought this note, this distressed mortgage note. That's why I was asking about notes earlier. And he said, I bought this distressed mortgage note. It was the second mortgage, and it was yielding 25% to him. And I was like, 25%? I just raised $90 million at 6%, 6.5%. 25% is ridiculous. So he said, he tried to explain it to me. He said, go to the seminar. I went to the seminar. Still a seminar. We're not at webinars yet. And I'll never forget what night it was. I couldn't tell you the date, but it was the game 1 of the World Series, 2009. Cliff Lee's on the mound for the Phillies against the Yankees, and I'm at a seminar. And I bring that up because sometimes I'm asked, is there a decision you made that changed your life? And I go right to that one. Because not staying home and watching that game and going to that seminar changed my life. Because what I learned at that seminar was about distressed debt. And I know we're about to talk about storage, but that's how I got here. So ended up learning how to buy distressed second mortgages, built an entire company doing it. That business was the wild, wild west. It still is a little bit the secondary market. I mean, for these, after the banks sell them to a secondary buyer, and then there's maybe sometimes a third and a fourth buyer. Holy cow, was that a wild, wild west scenario? We came in, cleaned it up, grew our business. We're one of the largest buyers of that in the country now, my other company, U.S. Mortgage Resolution. But even that had its down cycle. So 2009, we get in that business. 10, we formalized. Somewhere around 15 or 16, the CFPB almost puts us out of business because they put these onerous regulations on banks so you can't sell debt anymore. Or they made it so it wasn't worth it for the banks to sell debt. They didn't tell them they couldn't. So now what are we going to do? So now we're letting people go. It was a slow death. It felt like 1,000 cuts type of death. And so I'm looking for the next thing again. And in my inbox, because I probably had been to, between that business, the one before, 30 conferences in Vegas over the years. And I'm sure there was a self-storage guru at one of these meetings somewhere, but in either case, somebody got my email somehow, or they sold a list. Anyway, I get an email in my inbox. The subject line is real estate with no toilets, tenants, and trash. I'll open that. So I open it up, and in the body of the email, by the way, that's not true. I poke holes in that in a second, but the body of the email is what blew me away. And I at the time, if you had said, "Hey, of all the storage facilities in the United States, how many do you think are owned by the REITs, or what percentage, I should say, are owned by the REITs? Public, CubeSmart, and Extra Space." Driving around suburbs of Philadelphia for most of my life, I see Public, Extra Space, and CubeSmart, by the way, is 15 minutes from where I'm sitting right now. I would have said, I don't know, 80, 90%. I would have thought they were all of them. All right. I don't know anything about it. 80%. This is what got me. 80% of all self-storage facilities at the time I'm reading this email are owned by mom and pop owners. And I went, what? Because coming out of the distressed debt business I was in, where it was the Wild Wild West, it was the Wild Wild West because of dislocated, fragmented information, just even how these things were traded. It was just, there was nothing professional about it, in my opinion. You telling me 80% of an entire industry is owned by mom and pops, not institutions? That's opportunity. I don't know what it is yet, but I know it's there. So I got real excited about that. And I started leaning in and started to learn more. And I was, like, as I mentioned, it was from a guru, it was an education company. They were teaching people how to buy self-storage. A guy's named Scott Myers. And real quick on the tagline, we don't have toilets in storage, but we do have tenants and we need them. And sometimes they leave some trash behind, but so that's why I say it's not true, but it got me to open the email, and that was the most important thing. So I went through Scott Meyer's training program. I bought his at-home course. Then I went through his program. He's a mentorship and academy, and my partner and I went through it. And I mean that's how we ended up in the business. That's how we were mentored and trained. We bought our first deal, and recently just bought our 20th. We've got another one under contract, 2 more on the way. We're now developing not self-storage, but we're developing a tangent of self-storage called Pro Storage, which is business storage. And I'll pause here because I've been talking too long here. But that's how I got into that's why I'm here right now. And it has been an unbelievable ride. And self-storage, it is incredible. I actually teach at Scott Myers Academy now. I mentor and train people how to do it. It's been a wild ride and so exciting. And I wish I knew about this 15 years ago.
Yeah. Well, thank you so much for the background. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. One of the questions I have usually at this point is really on your current investment strategy and criteria. And you kind of just went over it there, where you guys are buying for value add, you're doing development. Can you talk a little bit about the pro storage and kind of a little bit behind, like, is that like a flex business type office / industrial type setup?
Yeah. So you're very, very close. So there is there's a new industry kind of popping up. It's always been around, but they're giving it a name now, and it's becoming in vogue, which is small bay flex, and that's what you just described, right? So small bay flex might be 1,000 square foot unit. Your 2-bedroom apartment, if you will. You're a multifamily guy, so your 2-bedroom apartment in self storage is the 10 by 10. That's our most common unit size everywhere, right? That's our 2-bedroom. That's 100 square feet. Small bay flex, anywhere, typically you're going to be about 1,000 to 2,500 square feet. Maybe you might find them smaller than that, but that's typically where they're going to be. And I say that size, they're slightly bigger. And I say that than what I'm about to tell you. And I say that size because what makes it small bay flex is, you nailed it, the office portion. So that's where I might want to operate my business out of. I need some sort of warehouse space. Maybe I need 800 square feet of warehousing, whatever, the tall ceiling, wider unit, deeper unit, and maybe 200 square feet of office, depending on what my business is. Or maybe I need a little more, it varies. That's small bay flex. From a bird's eye view or a satellite image, you might not be able to tell the difference between that and pro storage. They're going to look the same. The difference is, and there's a very fine line between them, Pro Storage and our brand Store Pro, it's just 1,000 square feet of storage or flex. Okay. There's no office in it. You're not working in it. That's the physical difference. And that physical difference matters from a construction standpoint. We don't have toilets. We'll have a toilet on site, but not a toilet in every unit. We don't have a fit out for offices. We don't need a sprinkler. It's a different use and occupancy. So all of that costs more, takes longer, whatever. I'm not saying it's not worth it. And we will actually dabble in it as well. I'm just identifying the difference. You're also dealing with probably 1-year leases minimum, probably 3 to 5 ideally, right? If I'm the owner and operator of that facility. We are pro storage. We are just take self and make it pro. Take your personal items, make them business. Instead of B2C, we're B2B. So no one's working in our facility. We don't need all that. It's a simpler build. That doesn't mean we don't function 90% the same. We do. And then my favorite part, to be honest with you, because we're dealing mostly with small businesses, is it's flexible in terms of your rent. So we're month to month. We kept it storage. So if you're a business, you're a startup, and you can't commit to a 3-year lease, or you're a startup and you need 1,000 square feet this year, and if you're successful, you're going to balloon to 3,000. You've got the ability to expand and contract with us, or even move somewhere else without being tied into some lease that's going to hold you up from doing that. Right. So, yeah, sure, we could lose customers because of that. We probably won't, because we have the ability to help you expand within our facility, right? If we have other vacancies. But that's kind of the key difference. But you nailed it. And that's becoming very in vogue now, both of them, because of the paradigm shift happening in how you're guilty, I'm guilty, everyone listening is guilty of creating this paradigm shift. And that has to do with logistics and Amazon. It's how we consume. Everything's getting delivered to us. We're not going to retail stores anymore. And that's changing the supply chain. And that supply chain change is putting downward pressure on the business owners that used to be in small bay warehouse and flex spaces, right? Now those are getting gobbled up by the Amazons and the Walmarts, who need them to be able to deliver goods to you same day. They're not even at same day. They are, but not the percentage of same day they want to be. So there's a lot happening going on behind the scenes with pro storage and small bay flex. Some of it's indirect, some of it will be direct. There's also businesses popping up that are going to be renting these units as well, Amazon wholesalers, et cetera. But there's a paradigm shift happening, and you know it just by what arrives at your door in cardboard boxes every day. So it's pretty neat. It's exciting.
So, Joe, we know about adding value through, if you're doing construction, it's easier. I mean, the whole commercial real estate investment business is about creating value, whether we're taking something from land, we're building something, but in most situations we're acquiring something and we're adding value to it. How that's done in apartments is, physical renovations, and we're fixing a little bit of management here. How is value added on your end when acquiring a self-storage facility? Great.
And I totally get the question, having a background in multifamily. So what you guys do to add value is very visible. I don't even know do granite countertops still exist in apartment malls? I don't even know. Formica countertops. I don't know if they still exist, but it's very obvious. Anyone, whether they're in commercial real estate or not, or in multifamily or not, can see the difference between old looking kitchen, bathroom, whatever apartment and new, right? It's very obvious. It's not obvious in storage. it's obvious to me, but my eyes are trained, right? We don't physically add value as much as we do from a management perspective. And that's where the mom and pop management, that's why I've focused on the mom and pop. It's their management style that's different than the institutional management style. All we have at our, even though we're buying smaller than public would buy facilities in terms of square footage, we're still able to manage them the same way public does. 10 years ago, you couldn't, but today all the technology exists to be able to do that. So here's a great example. When I buy a mom and pop facility, when I'm done with it, meaning after I transition it, so a week later or a couple days later, not 5 years later, within a couple days of us taking it over, you can find it on your cell phone. You probably couldn't before. You can rent the unit on your cell phone. You probably couldn't before. We're going to force you, frankly, to add your auto pay. So put a credit card or a debit card down. We're not chasing you for rent every month. It's going to be automatic. And then we're also going to, and this is just a little bit of a value add too, is we're going to require you to use either tenant protection or tenant insurance. I don't want to get into the difference. It doesn't matter. It's the same thing to us. And that's just another little revenue pop. So it might take me from $100 a month for a 10 by 10 to $106 a month for a 10 by 10, right? So that little $6 times X amount of units matters. It's that sort of thing. It's not, a lot of people think when I teach them like, oh, so you're going to take that gravel lot self-storage facility and pave it. No, I'm not. I'm absolutely not going to do that unless every single competitor is paved. And that's the only way I can raise my rents and keep up. And it also makes sense from an ROI perspective. Otherwise, I'm not doing that. People don't care. They're renting with the gravel. They're going to keep it gravel. We do make physical upgrades that do matter, though. If it's not fenced, if there aren't security cameras or adequate lighting everywhere, the majority of self-storage renters are female. We want to make sure that when a female drives on our lot or looks at our lot or finds it on the phone, that we're letting them know either verbally meaning in the written word, digital written word, or visually, it's very secure and safe at all hours of the day. So it's the gate, the fence, the lighting, the cameras. If that's not there, we're installing all that. Would you even notice? I doubt it, right? I mean, if you were a customer, you might notice there's a gate where there didn't used to be one, sure. But would you notice we put cameras in every corner so we can see every inch of the facility? Probably not. You're not looking for that. So it's not obvious, right? It's a little different that way. To answer your question, our value is added through management. And that was just the first layer. From there, it's, how do you manage your rates? So we're using the same technology that airlines use or hotels use. Right. So it's dynamic pricing. So now, not to the extent the REITs are, you go on a website for a public or a cube store. In the morning, you might see one rate for 10 by 10. In the afternoon, you might see a different rate, higher or lower. They're changing them hourly. We're not changing our rates hourly. We have the technology to do it. I don't see the benefit in it. But we're following theirs, and we're keeping up at least on daily, trying to stay competitive. If they're even in our market, if they're not in our market, it doesn't really matter. But we're changing our rates based on our competitors and the availability of the marketplace.
So, how do you guys usually typically source your facilities? With when that email you said 20 years ago was written, 80% was owned by mom and pops. Obviously, that's a little smaller now, but there's still a substantial amount of self-storage and mobile home parks. Both of those asset classes are predominantly owned one-off by mom and pop operators. So kind of how do you guys source it now? Is it through brokers or is it a mix from direct to owner?
Yeah, great question. So we've acquired 20, 15 of them are off market. 5 have come through brokers. So there's no shortage of deals listed through brokers. And when I educate students, I get on every list. There's a number of reasons to do it. I want the deal flow in my inbox. It's just not where we're finding the most value. So I used to call myself. Now we have a team of VAs calling, but we're more of a company, right? With overhead and a business. We're trying to grow in a portfolio. A lot of folks get started. That's not what you're trying to do. You're just trying to do it yourself. Maybe you want to buy 1 or 2. Maybe that's your goal. And that's fine. You don't have to be like us. In which case you don't need a team of VAs. You could hire VAs, but it's pretty simple to look. Everything is almost free at this point. Information's free. between AI and Google at this point, you can find out everything you want, including storage facilities. You could, wherever you're sitting, let Google know your location. Just type in storage near me and you'll see storage facilities pop up. So there's any number of ways to find them. We use VAs. We do sometimes buy from brokers. And the VAs all they're trying to do is get me appointments. I'm still the one doing the conversations with the seller or the potential seller.
Yeah. No, that makes perfect sense. So kind of over the last few years, it's slowed down a little bit, I guess, over the last 2 or so years. But I mean, new self-storage construction deliveries have decreased over the past couple of years, but an estimated still $50 million, new rentable square feet are coming online this year, 2025 alone. I mean, should this be a concern for investors? How does this affect what you're doing? I mean, you're doing construction as well. I mean, how does this change your business plan, if any at all?
Yeah, great question. National stats are important, but to be aware of, but storage is a local business. So 50 million new, well, let me cover the national first and what that means. 50 million new square feet is maybe 2% of the entire, maybe growing the entire population of square footage of storage by 2%. That's keeping up with our growth rate, not counting we have a natural growth rate and we've had a recent artificial growth rate as a way to say it, I guess. So that's kind of keeping up with it. National average of storage, our supply index that we look at is not applicable everywhere, but it's important to know because it's applicable in most places. We're looking for 8 to 10 square feet. That's a properly supplied market. Nationally, we're at 6. So adding 50 million moves it by like 0.15%, right? It's not a big, not 0.15, but less than 1%. So that's not a big mover. By the way, the reason there's the number of new projects has slowed is because of interest rates and rates the year we came through. So that just means it's not feasible to continue. So they're probably just paused versus just killed. But the 50 million that's coming, it's not statistically significant is the answer to your question. But if I may tie it locally, it doesn't matter. It matters to me if I'm in a market that's properly supplied and you're telling me there's another 3, 4, 500,000 square feet coming, that's going to hurt. In an undersupplied market, it doesn't hurt. If you're telling me no new supply is coming in my market, what do I care? Right? Because I only care about my market where I own. What is my market? 1, 3, 5 miles or 15 minutes of drive time, depending if I'm rural. So my market's very low. Storage is hyper local.
Yeah. Can you explain a little bit? Because you did it kind of like inside jargon almost. You threw out like, no, it's fine. It's the 6 feet, 6 square feet, the 8 square feet, the 10. I understand what you're saying, but can you explain how that's done? Because that's an important thing about knowing, like like you said before, if there's too many units in the area and this isn't feasible.
Yeah. So it's just the ratio of square feet per capita per person, right? So for every person, I'll say it this way, if a market has more than 10 square feet of available, not rented, just available storage. So that would include rented and unrented. I'm trying to be clear here. Total storage, square footage in a market, if it has more than 10 square feet per person, that market is starting to become oversaturated. With exception, Florida, 20. Why? No basements, no attics, right? So that rule doesn't apply in Florida or anywhere where there's no basements and attics, which sometimes means mountainous towns and whatever. New York City doesn't apply. And neither does the 1, 3, and 5. 1 mile in New York City is another world, right? You're in blocks in New York City. Just as an example. So the more urban you get, that number goes out the window. When you get into areas where there's a physical difference between where you and I live and where most of the country has attics and basements, then that number can change a little bit. You start to, you take away, Arizona, I think is an area, California, not a lot of basements, but then that number doesn't apply there either. So the number gets tweaked a little bit, but that's what the number means. It's total square footage per person. So it's 8, 7, it used to be 7. Now they're saying 8 to 10 square feet per person. So right now, nationally, we're sitting at 6.1. So adding 50 million takes us to like 6.25 or something like that. It doesn't really move the needle. It's a nice stat and a headline for whoever wrote the article. It reminds me of the days where the strategic defaults, when we lived through it. Well, we still live through it. There were no strategic defaulters in mortgage. It was the headline.
No, I appreciate you clarifying everything and kind of how you're looking, because that helps how you're picking markets too, and lets us know a little bit about kind of what the metrics you use. So that's a lot of helpful information there. Kind of as we're wrapping up here, I just want to get a little bit of advice. If there's people out there that want to get started buying self-storage from aspiring self-storage investors, can you give us a little bit of information of what you would suggest if, say, they wanted to go and start sourcing their own deals?
Yeah, I wouldn't. It looks like it's easy and it's not hard. I'm not Elon Musk. I'm never going to be Elon Musk. I'm not that smart. I'm just regular Joe Downs. But I've gotten to where I am because I've immersed myself through it, and I went through training and mentoring. And now I'm not even going to say that. I am very experienced in self-storage. I've been through ups and downs. I've even been through some market cycles in self-storage. You can get here too, but I would go through training and mentoring. And if you email me, I can point you right over to Scott Myers, where I went through that program. Well worth it. If this is something you really want to do, I wouldn't recommend you do it on your own. I think you really do need a mentor, someone who's going to save you from making mistakes. It's, by the way, an incredible business to get into right now. Low barrier to entry. You have, I saw a stat the other day. I don't know if you saw this, Charles. 2.4 million cash flowing businesses will change hands in the next 10 years because they're owned by people 65 years and older.
Yeah.
At least 20,000 of them are self-storage facilities owned by mom and pops. The time has never been better for, and then you have the SBA. You can use SBA loans for self-storage. I love multifamily. I love investing in you guys as operators. I like being passive in that space, but you don't get to use SBA loans. We do. Why? Because it's a business. So that means I can get a 90% loan to value loan if I want to buy a self-storage facility. You can't do that in multifamily or office or retail. So that's another interesting little tidbit. It lowers the barrier for most folks to be able to in their natural progression of I'm a real estate investor, and I flip houses, I own 10 single families, whatever. I own small multifamily. What's my next step? Self-storage can be a next step for you. It's a natural progression. And then I would also add, I think we're still buying them on sale right now because we just came through a terrible 2 years for self-storage, and you're buying the trailing 12 numbers.
Yeah.
So I think they're on sale. They're at a discount.
Well, a lot of great information, Joe. Thank you so much for coming on. How can our listeners learn more about you and your business?
Yeah, Joe Downs. The Belrose GRP is our website. Belrose Group, belrosegrp.com. My email is the best way to get me. Joe at Belrose AM. Sorry, it doesn't match, but it's Belrose Asset Management. So BELROSE, A as an asset, M as in management.com.
Okay. Well, Joe, thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Charles, really appreciate you having me. Thank you. It was a lot of fun.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndications Superstars, LLC exclusively.